All right, chapter 3 on and poppin'. Let's talk about leading and lagging indicators. So, what are leading and lagging indicators? Well, leading and lagging indicators, 3x bonus, are tools that evaluate the strength or weakness of economies or financial markets. Now, simply put, leading indicators change in advance of an economic cycle or market trend. Now, in contrast, lagging indicators are based on previous events and provide insights about the historical data of a particular market or economy. In other words, leading indicators provide predictive signals before the occurrence of events or trends, and lagging indicators generate signals based on a trend that is already underway. Now, these two classes of indicators are used extensively by investors and traders who employ TA, making them quite useful in stock, Forex, and crypto trading. Now, in financial markets, technical analysis indicators have a long history that stretches back to the early decades of the 20th century. The idea behind these indicators is rooted in the development of the Dow theory, which occurred between 1902 and 1929. Now, essentially, the Dow theory asserts that price movements are not random and therefore can be predicted by using thorough analysis of prior market behavior. Other than that, leading and lagging indicators are used for mapping economic performance, and as such, they are not always related to technical analysis and market prices, but also to other economic variables and indexes.
There are many different types of economic indicators. In one sense, indicators are statistics that measure an economy's growth or contraction. In another, technical analysts use indicators from a stock's past performance patterns to try to predict what it will do next. Investors use indicators to measure economic conditions and forecast financial and economic trends. Indicators are essential tools because they can help investors gauge the risk an investment presents before choosing what to do with their money. For example, the Bureau of Labor Statistics issues reports on several key economic measurements, including employment and unemployment rates. A spike in unemployment can reveal that an economy is underperforming and gross domestic product is likely to fall. It can even foreshadow a recession. Other economic indicators investors should watch include manufacturing, real estate, interest rates, the money supply, and consumer sentiment. Many of those started downward slide before economic hard times. A good example of a technical analysis indicator is the Moving Average Convergence Divergence, or MACD. It uses the difference between short-term and long-term price trends to anticipate future movements. The MACD line comes from subtracting a security's 26-day exponential moving average from its 12-day EMA, and then plotting it on a graph. Then plot a 9-day moving average called a signal line on the same graph. When the MACD crosses above the signal line, it's a bullish sign that should trigger a buying decision.
So, how do leading and lagging indicators work? Let's start with leading indicators. So, as I mentioned, leading indicators that can provide information about trends that are yet to emerge. Therefore, these indicators may be used for predicting potential recessions or recoveries. For instance, in regards to stock market performance, retail sales, or building permits. So leading indicators tend to move ahead of economic cycles and are in general suitable for short and midterm analysis. For example, building permits can be considered a kind of leading economic indicator. They may signal future demand for construction, labor, and investments in the real estate market.
A leading indicator is a measurable economic factor that tends to change right before the economy starts to change. While they're not always accurate, leading indicators frequently correspond to changes in an economy or market, either upwards or downwards, and are used to predict movements and trends. Some of the common leading indicators are the stock market, retail sales, building permits, the housing market, and business startups. For example, a strong stock market may indicate company earnings are up and the economy is about to improve. Of course, if earnings estimates are wrong, the stock market's indication may be misleading. On a smaller level, the performance of one company's stock could indicate how other stocks from the same industry are about to perform. Manufacturing levels may indicate what shape the economy is in. If fewer goods are being made, there may be less demand for those goods, which could mean the economy is about to slump. Or an increase in housing prices may mean demand is exceeding supply. An increase in sales could be a good sign for an economy. Any indicator can lead to the wrong conclusion, so it's important not to focus solely on one change. But indicators can shed light on what's likely to come in a market or an economy and should always be assessed before buying a security. Many governments use leading indicators to guide their decisions on fiscal policy and other financial matters.
Now, what are lagging indicators? So, opposed to leading indicators, lagging indicators are used to identify existing trends, which may not be immediately evident on their own. Thus, this type of indicator moves behind the economic cycles. Typically, lagging indicators are applied to long-term analysis based on historical economic performance or previous price data. Now, in other terms, lagging indicators produce signals based on a market trend or financial event that has already been initiated or established. Many traders and chartists deploy TA tools that can be defined as either leading or lagging indicators. Now, essentially, the leading technical analysis indicators provide some sort of predictive information. They are usually based on market prices and trading volume. This means that they may indicate market movements that are likely to happen in the near future, but just as any indicator, they are not always accurate. Some examples of indicators that are used in technical analysis include the RSI, the Stochastic RSI, and the MACD. In a sense, even the candlesticks may be considered as a type of leading indicator due to the patterns that they create. Now, in practice, these patterns may provide insights into future market events. Now, on the other hand, lagging TA indicators are based on previous data, giving traders insights about what has already happened. Now, still, they can come in handy when spotting the beginning of a new market trend. For example, when an uptrend is over and the price drops below a moving average, this could potentially indicate the start of a downtrend. Now, in some cases, the two types of indicators may be present in a single chart system. The Ishimoku cloud, for example, is composed of both leading and lagging indicators. Now, whether they are used in technical analysis or macroeconomics, leading and lagging indicators play an important role in many types of financial studies. They facilitate the interpretation of different kinds of data, often combining multiple concepts in a single instrument. And as such, these indicators can eventually predict future trends or confirm that those are already happening. On the other hand, they are also useful when evaluating the economic performance of an entire country, either in relation to the previous years or in comparison to other countries.